Valuing a stock's true worth is similar to valuing a car before buying it. You wouldn't buy it just because it looks good, or because it has powerful engine, or because it's cheap, or even because it runs smoothly. You will evaluate all these features and more before coming to a conclusion regarding whether or not to buy that car. Similarly, investing in a company also requires you to analyze certain metrics called as financial ratios. Similar to a car example, each financial ratio reveals a different aspect of a company. Remember, each ratio is like a piece of a puzzle. So to get the full picture, you need to put all of them together. Don't worry, it might seem a little scary at first, but once you start, it actually becomes quite simple. First, let's get you familiar with all of them before we dive into the details. So, we have the PE ratio, PB, PS and EV by EBITDA. PE ratio measures the profitability of a company, PB measures its assets such as machinery, buildings, etc. PS measures its sales strength as in the demand for the company's products, and EV by EBITDA measures the actual money being generated by the company. See, from a long-term perspective, understanding a company's fundamentals are crucial because after 5-10 years down the line, you don't want to look back and curse your younger self for betting on a stock you didn't truly understand. On that note, let's get started. Hello and welcome to Alice Blue's YouTube channel, where we simplify everything related to investing, trading and personal finance, one step deeper and one level easier. The PE ratio compares a stock's price to its earning, similar to how you compare the price of a product to the quality of a product. It's like asking, is this product worth the amount I am paying to buy it? PE ratio is calculated by dividing the stock's price by its earning per share. For example, if I Google Bajaj Auto annual report, download the report, go to the consolidated financial statements, find the P&L or profit and loss sheet, and then locate the basic and diluted earnings per share, find the stock price by googling Bajaj Auto NSE, copy that and paste it on my Google sheet. Now apply the formula and round off the values. Beautify it. Now let's compare this PE ratio with its peers. So for that, go to Google, search for Automobile Industry PE Ratio India, click on the screener link, go to Constituents, and there we have all the PE ratios of automobile industry. And we even have Bajaj Auto's PE ratio, which we just computed. Copy this and paste it on the Excel sheet and find the median of all the PE ratios. And we get a PE ratio of 32.16. We can see that a PE ratio of 32% is fairly priced in this case. Keep in mind that this ratio will differ across different industries. So if the PE ratio were high, it could mean that the stock is overvalued, and a lower PE ratio could indicate that the stock is undervalued. However, the PE ratio is dependent on a company's earnings, and earnings alone cannot reflect a company's true financial health. Because what if a company is earning a lot of profits but is neck deep in debts? Then all the profits will be spent on paying off the debts, effectively nullifying the profits. Hence, the PE ratio alone cannot give you the whole picture, especially in case of startups and turnaround companies, because they might not even be generating profits. Next, we have the PB ratio. PB ratio checks how much more or less you're paying compared to what a stock is worth based on its assets like cash, buildings, machines, etc. It's similar to checking the ingredients in the back of a product. You can just add up the price of the ingredients based on their quantity and see how much extra you're paying compared to the product's actual price. If the product costs way more than its ingredients, you might be paying extra for branding, packaging, or marketing. If it costs less, it might be a great deal, or it might mean that the ingredients are outdated or something is wrong generally. So PB ratio is the market price divided by the book value. Market price you can find online, which we already did. Book value you'll have to calculate, for which you'll need to divide the total shareholders' equity by the equity share capital. Total shareholders' equity you can find in the balance sheet over here, total equity.
And equity share capital you can find right on top. Okay, now we can calculate the book value per share. So apply the formula. But before we move, we need to divide this equity share capital by 10, which is the face value.
For example, if a pizza costs rupees 900 and it is cut into 9 equal shares, then the price of one slice is calculated by dividing the total price by the total number of slices, hence rupees 100 per share. This slice is called the face value for companies, which is set to 10 rupees per share for most Indian companies. Hence, we divide the equity capital by 10.
Now let's find the PB ratio. Round this off.
Such a high PB ratio indicates investor confidence. In this case, it might be due to Bajaj being a household name, its solid foundation, and its strong performance over time. But what if it's a company that you're not familiar with? Then how can you measure the high valuation is being supported by strong sales performance? That's why we have the PS ratio. It shows us how much revenue it generates relative to its stock price.
Okay, so I beautified this a little. Now for the PS ratio, we need market price per share, which we already have. And then we need the revenue per share, for which we need the total revenue and the number of shares. Total revenue you can find in the profit and loss statement, this revenue from operations, and number of shares is the same as the equity share capital, so you can copy and paste it here. Now apply the formula and we get the revenue per share. Now let's calculate the PS ratio. Same, apply the formula, total revenue divided by number of shares, round it off, and there you have it.
Now this means investors are paying 5 rupees for every 1 rupee of sale. Again, in this case, Bajaj Auto being a premium business, investors believe Bajaj is capable of turning a good portion of its sales into profit, and future sales growth is expected. PS ratio might look similar to both PE and PB, but PS ratio works even if there is no profit generated for the company at all. For example, a company may reinvest every rupee of profit it makes, which will make it look bad on PE, but PS shows strong demand and growth. The last ratio which we'll be discussing in this video will be EV by EBITDA, which is one of the cleanest tools for comparing real operational value, because it shows you how much cash flow you'll be getting for owning the company. Similar to those cafes and restaurants which generate money after buying in those Build a City games. EV is the cost you'll have to pay to buy a company, including the debts. So it includes the market capital, which is the shareholders' money, plus the debt and minus the cash, because that's the money you instantly get when you take over. EBITDA is earnings before interest, taxes, depreciation and amortization. It's like the raw cash profit a business generates, similar to your in-hand salary before you pay off your rent, EMI or taxes. So when you divide this EV by EBITDA, you get a clear picture of how expensive a company is relative to the cash it generates. A low EV by EBITDA means that the company can pay off for itself fast, so a potential good deal. Whereas a high EV by EBITDA means that it might take some time to get your money back, hence it might be overpriced.
So we need EV and EBITDA over here. To calculate EV, we'll need market cap, debt and cash. Market cap you can find by multiplying the number of shares with the current stock price. Debt will be the sum of the non-current and current borrowings, which you can find in the balance sheet. There's the non-current borrowings and there's the current one. Okay, so if we add these two up, we'll get the total debt. Same goes for cash, which will be the sum of cash and cash equivalents and other bank balances, which again you can find in the balance sheet. There's cash and cash equivalents and there's other bank balances. Add these up and we'll get the total cash. Now that we have all three of these values, we can calculate the EV. Here, that's market cap plus debt minus cash. There's the EV. Now let's calculate the EBITDA, for which we need all three of these values. These values we can find in the P&L statement. There's profit before tax, finance cost, and depreciation and amortization expenses. To find the EBITDA, we need to add all three of these values together. There. Now that we have both the values, we can compute the ratio. Apply the formula, round it off, and there we have it.
Again, 22 rupees for every 1 rupee of operating cash flow means that investors value it highly. They probably see it as a well-managed company with a stable cash flow. But this could also mean that the expectations are high. And as compared to other stocks, it will make this one expensive. With that, we reach the end of this video. For more videos on the Fundamental Analysis series, click here. And I'll see you guys next time.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.